Gene Pastula, my special guest and guest host for this hour of Money Power on the Ray Lucia program. If you'd like to get in contact with Gene, he's a super, super good guy. SafeMoneyMonitor.com. Don't let him convince you otherwise, because he really is a good guy. 800-809-6783 is also a lot of fun to tease. But Gene, I do have to compliment you. I'm reading J. Korn here, Donald J. Korn.
Oh, I know Jay.
New strategies for ensuring long-term care. Emily Gurnon writes, the staggering prices of long-term care. Well, Emily is pretty much saying prices are going through the ceiling for traditional long-term care policies. Donald J. Korn is saying the old way of funding long-term care, the way that I funded it 10 years ago, is passé. The new way, and I chuckled when I heard like the new way, because you started this like 30 years ago.
Yeah, and I used to talk to Donald Korn about it too, and he wrote a couple articles.
Really?
Yeah.
So you really do know Donald Korn?
Yeah.
Oh, really?
Yeah, he's a financial writer, writes in a lot of the industry magazines and stuff like that.
You're my hero. Do you know Emily Gurnon?
I do not know Emily.
You know Ray Lucia,
I
that
do.
guy on the radio and television.
I'm 2 out of 3.
Here's what he says. Many people don't want to use traditional long-term care approaches, and they went on to look at the number of traditional policies that were sold, like in 2016 versus 2011, and it's stunning. When you look at the life insurance long-term care combos compared to, and I don't know what the metrics are, it doesn't matter, 228 versus 3,600. I mean, I don't know what times that is, 15, 16 times more policies.
Well, I mean, you have to give a little bit of credit to the fact that the what we call linked benefit, the life-based products, are newer, and we developed them in 1987, but I guess we didn't really go real fast in informing the world.
Well, I have to say you and I were ahead of the game, because you helped me write a chapter in my very first book, which I worked on, by the way, in early 2000. I don't think it came out through 03 or 04.
Yeah, well, we had been doing it at least for 10 years before that. Yeah, but it's like back to the conversation we had in the last segment. If you're not paying attention, people don't pay attention. You got to tell them 3 or 4 times, and so anyway, it's taken a while, but that has been that approach has been the most popular and is fastest growing.
Here's what Donald J. Korn, your friend, had to say. The main reasons that he calls it asset care products are more popular, the hybrid, if you will, life insurance and annuity policies have guaranteed premiums, offer lifetime benefits, and provide for money for beneficiaries if the client never needs long-term care. They go on to talk about the money-back guarantees and so forth. All of the stuff that you pitched me on 30 years ago. And
he's talking about one of the companies that we represent. We represent them all if we need to, but they obviously, got, to him and said, it's time to tell the world about this again. And so he's doing it. But yeah, and that's a particularly excellent, the carrier's good, and they've been doing that product for a long, long time. So your recommendation for individuals that are watching the program on television, sitting here, listening on the radio and so forth, really amazing, I think, situation that you invented. What are you going to tell them today? Well, just to follow up to Donnie's article there in that particular product, for example, think about it. If you could take money that's sitting in a CD or some safe place that you have it as an emergency, that's not obviously it's not getting much interest now. It's not very exciting. But you could move it to the insurance company and say, and they would say, you give us, and we'll use $100,000. Could be 50 or 25 or 150. $100,000, and we will give you a life insurance policy that would pay out $200,000 ultimately at death. All right. And in the meantime, the cash that you put in there is always available back to you. All right, you can get that back anytime you want, but if you leave it there, it'll be worth this much. But if you need money for care before you die, which is very common, you can also tap the $200,000, and and we'll use that to help you pay for cost of care.
Tax-free.
Tax-free. Now, the beauty of that is, and that'll be whether it's you or your spouse, either one of you. Okay? So by just moving that, you've created a $200,000 pot of money instead of $100,000 plus a little bit of interest each year to pay for convalescent care. All of it's tax-free, and it's totally guaranteed. It's not going to change. Now, for you and your wife. Now, for an extra few $1,000s a year, $1,500 per person, if you will, we will continue, the insurance company will continue to pay benefits for as long as either one of you live, for your entire life, if you need it for long-term care. So with basically just moving money from one place to another, we used to talk about left pocket, right pocket, whatever, but by simply moving your money to a different asset that's very safe and secure, I know that, I've been doing business with these people for 25 years. First of all, you leverage that, even if you never need it. When you and your wife have passed away, your kids will receive a couple $100,000 tax-free in my example. But when either one of you need the care, now the odds of one of you are pretty high.
Very high, 70%.
Yeah. And it's I've been doing this a long time. It's not unusual to see the second person, follow into a long-term care situation.
Well, especially if they took care of the first person.
Yeah, well, just the stress of it,
sure,
kind of ages you fast and all the rest of the stuff. So you have literally an unlimited benefit for long-term care for as long as either you or your spouse are living.
Now, when you say unlimited benefit, what does that mean?
It means for the rest of your life.
And how much do you get from that $200,000?
Well, in the case of the $200,000, the monthly allowance per person would be about $4,000 a month. About $6,000 a month.
$6,000 a month for each, my wife and myself, forever?
Yeah.
That has to run out at some point, doesn't it?
Yeah, when you do.
Seriously.
No.
Now that's a little different than the one we normally talk about.
Exactly. And because it's a little more complicated, to do on a 10-minute segment. But the point is that there is a whole variety of these things that that people can use to. I have one that I talk about more and more all the time, of an individual, 70-year-old man that his daughter was bugging him about long-term care and getting insurance. He was a widower, and he says, Gene, I don't need long-term. He heard me on your show, and this has been a couple years ago. And he says, but she's on my case, and he says, I heard you on Ray's show, and he says, it sounds like a really good idea. And what we did was we took the money that he was paying for, or was receiving as a required minimum distribution, netted the taxes, because he says, I don't, we were talked about that, and he says, no, I don't need it, and to live on. We netted the taxes, and then we came out with like $12,500 after tax each year. Actually, is going to grow each year. But we set up a life insurance policy for him, and he's 72 years old. He doesn't need life insurance per se, but we set the life insurance policy up that was $280,000. So when he put the first $12,500 in, he had a death benefit of $280,000. But the $280,000 could be used to pay for his long-term care. So he knew he wasn't going to need it. I'm not sure how he knew that, but
he talked to God.
Maybe he did. But basically, he satisfied both problems. look I really want my daughter to have the money that I've got.
It was $12,000 a year?
$12,500 a year at 72 for
like 300 grand.
Yeah, exactly.
So if he kicks off tomorrow, that's a heck of a rate
what a
of
return, huh? Yeah, exactly.
But even if he kicked off at the end of his life expectancy, that's still not a bad rate of
actually,
return.
I figured it out at 94 if he died.
Well, that's
his
well
rate of
beyond his
return
life expectancy.
I know, his rate of return was like 4.5% tax-free.
Yeah, well, you can't buy a muni bond for that. I mean,
No. It's all very, I mean, it's financially sound, particularly if you're in average good health at that age.
Folks, you want to call Mr. Gene Pastula and learn about this. He's got all these tricks up his sleeve. He just pulled another one off on me. I've been interviewing him here on this program for 5 years, 10 years. I don't know how long it's been, but I've known him for 30. 800-809-6783. See if something like this might work in your portfolio. We'll be back.